Hi, this is Rob Waller from Business Loan Services. Well, the government has finally yielded to pressure and come up with a small business variation to the CBILS scheme, the Coronavirus Business Interruption Loan Scheme. As we know, many small businesses are complaining that they haven't been able to access the scheme and that it is very slow. And of course, the fact that the government is only guaranteeing 80% of the debt, which many people think is leading banks to being less than positive when it comes to supporting the smaller end of the market. So the Chancellor has listened and now come up with the snazzily and positively named bounce back loan. So what does it look like? And are there any catches? Well, of course there is one, which I'll go through later. First of all, let's look at the scheme overall. It's available for all small and medium-sized businesses. The loan amount starts at £2,000 up to a maximum of £50,000, subject to a maximum of 25% of your turnover. The term loan is 6 years. For the first 12 months, there are no capital repayments to make at all, and also during the first 12 months, no fees or any interest is payable. So that's very good from a cash flow perspective. The key thing, of course, though, is that the government is now guaranteeing 100% of the debt as opposed to 80% under the normal CBILS scheme. The idea is that this will take the pressure off the banks because they now know that they are not at risk at all, and so can be speeding up the whole process. Now, the application's open with effect from the 4th of May at 9 a.m. and you'll be able to apply through a number of accredited lenders, who I'm assuming are going to be the same ones that are accredited under the CBILS scheme. Now, if you also do have an existing CBILS loan less than £50,000, you will be able to apply to your lender to switch to this new loan up until the 4th of November 2020. Now, what about eligibility? Well, you've got to prove that you've been negatively impacted by the coronavirus, and there's also one additional clause which many people have kind of missed. It's called that you can't be a business that is an undertaking in difficulty. You cannot be deemed as an undertaking in difficulty. Now, what exactly does this mean? It's a bit of a strange term. Right, I've done some research on this to see exactly what it is. And of course, there is now a little bit of a hidden trap. So let me tell you what the definition of undertaking in difficulty is. Now, I'm having to read this just to make sure I get it right. So an undertaking in difficulty is unless a business is less than 3 years old or within 7 years of its first commercial sale, if a business has accumulated losses greater than half of its subscriber share capital as at the 31st of December 2019, it will not be eligible. Now, it's all a bit gobbledygook, and I'll explain in a minute, but it's all down to state aid rules and tied up with the European Union about what governments can do in terms of supporting businesses. If you're a bit of a geek, and I am a little bit, here's the exact article. It's Article 2, subsection 18 of the Commission Regulation EU number 651/2014 of the 17th of June 2014. So this thing goes back quite a while. So this is a thing that you have to be really careful of. So what does it mean about accumulated losses? Well, if you go to your balance sheet on your annual accounts and have a look at the bottom figures. Now, if your figure is in brackets, it means that your business is technically insolvent. And what we need to be looking at is your share capital. Now, in many instances, share capital typically comes to £100. So half of the £100 is £50. So your accumulated losses cannot be more than £50. Now, for many businesses, that's just not going to work. Now, the majority of businesses, their balance sheet is in profit or in a positive territory. But if you've got an insolvent balance sheet because you've had previous losses and you haven't been able to trade out of that yet, you will not be eligible for this scheme. So it's okay, say, if you're in positive territory, but if you've had a troubled past and your balance sheet is in deficit, you're not going to be eligible for the loan. So the first thing you need to do before you apply, dig out your balance sheet and have a look to see where your figures actually stand. Overall, not a bad scheme, but of course it's very early on. Those applications haven't opened yet. So let's see exactly how all of those banks treat this new bounce back loan. Now, if you want more information and a bit of support around raising the finance, don't forget you can just drop us an email, info@businessloanservices.co.uk.